The sharp correction in TCS is the result of 6 major factors hitting the company at the same time. Today, we look at each of these and see how TCS and other IT stocks like Infosys, Tech Mahindra, Coforge, Wipro, HCL Tech and others can fight their way back. We will also discuss the top 3 IT stocks that I would buy into when I see signs of recovery. This is not investment advice though, just my opinions as a trader who saw a trading screen before he saw a cricket ball. Now, why has TCS corrected so sharply? First is the weak demand and cautious client spending. As Reuters reports, and I quote, as clients reel under macro and tariff uncertainty, there is hesitation to commit additional dollars to any large initiatives. Meaning, companies are hesitant to commit a lot of money to IT spending because they expect an earnings slowdown caused by tariffs, high interest rates, and geopolitical turmoil. Here is the expected growth chart for these IT companies, where you can see that TCS is expected to show the slowest growth. IT has also been the sector with the largest FPS selling of this year, almost 3 times the next highest, which was power. Clearly, slower growth and lower revenue visibly hurt investor confidence. Second is a very TCS specific issue, which is the ramp down of an 18,000 crore order from BSNL. This was one of the largest contracts under TCS's belt, and as such, it has hurt TCS's revenue in a big way. Now, this project's ramp down was expected, but geopolitical uncertainties and BSNL's management decision-making made this ramp down much faster than the market expected. This was notably a low-margin contract, so this ramp down, while hurting TCS stock's revenue, actually helped with higher profitability. A greater impact was felt by Tejas Networks, which saw a major drop in revenue and hence the sudden collapse in Tejas Networks stock as well. The third is margin pressure that came in from the cost of new skills, inflation and rising competition. As AI takes center stage, even giants like TCS have tried to evolve. However, to do so, TCS would have to hire employees with a very different skill set and set up computing tools of a unique kind, both of which come at an additional cost. These costs have eaten into most of India's IT stocks' margins. The systemic inflation and rising competition from new age firms have also squeezed these margins tighter for TCS, Infosys, Wipro, but also for mid-cap names like Coforge, Persistent and Birlasoft. Trump's agenda of protectionism has also hurt Indian IT companies overall. TCS in particular has been under investigation for hiring Indian employees over US citizens in the US. The company has obviously denied these claims, but the US government's efforts to shift IT jobs to native US citizens implies higher employee costs. At the same time, the uncertainty around President Trump's trade policy means that one day, any day, he could declare a 50% tariff on IT outsourcing. He has already hinted as much, warning US companies to try to meet more of their IT demands in-house or through US-based firms. This has made clients cautious in signing long-term contracts with Indian IT firms. This stock is also trading well below all technical supports, having given a death crossover in February 2025. A death crossover is when the 50 DMA slips below the 200 DMA and is considered one of the strongest sell signals in technical analysis of stocks. Its long-term price support stands at about 3,000 and it has been testing that support thoroughly for the past 2 months. Any break below 3,000 would be a major red signal. Finally, the biggest cause for all of Indian IT struggling is the rise of AI automation. While TCS is spending heavily on an AI pivot, these changes have been more gradual than radical. What I mean by that is that TCS shouldn't be looking at doing the same work it has been doing using AI. It should instead be changing the kind of work it does. See, most of the outsourcing work that TCS and a majority of Indian firms do is maintenance and support along with peripheral coding. In simple terms, Indian IT firms do not invent systems, they build based on the specifications provided to them. This is exactly the kind of work that AI would replace first. So the prices that clients are willing to pay for these jobs have shrunk to bare bones. That means lower margins and lower volume for the foreseeable future. That is bad for any business. So either TCS can pick up many projects to get to the same level of income as earlier, or it would have to do something radically different, something that AI cannot do. The first is a losing proposition because the competition in this space is going to skyrocket. The entry barrier to creating and managing software has virtually disappeared since anyone today can build an app or write a code without even knowing what 0 and 1 represent for computers. That's the power of AI. So the likelihood that TCS will start scoring many more smaller orders to increase its revenue is slim. And the latter, where TCS and other Indian IT stocks build novel technologies, requires a kind of talent that these companies have never really made their main focus. That is the kind of radical change these companies need to create. Fewer employees with much higher pay who can solve problems that clients don't even know exist. Then our IT firms can charge above market rates and finally bring back the margins they had 5 years back. In short, TCS is facing a more difficult environment than in any previous cycle. Demand softness, margin risk, regulatory and trade overhangs, and technical weakness all combine to create the perfect storm for Indian IT. And for these companies to recover and deliver the kind of returns that we investors are used to, one of the following must happen. First is demand rebound, which means global IT spending picks up, especially in North America and Europe. This could kickstart strong deal cycles to reignite earnings expansion for Indian IT. The second is margin recovery through cost control. If TCS demonstrates margin expansion via automation, scale, or better pricing, that goes beyond investor expectations. That could help it re-earn its high multiples. To do so though, the company must show some big deal wins, especially multi-year deals, or create meaningful progress in its AI and data center pivot. All of this can happen if we just get an easing of regulatory risks. If US-India trade tensions soften or outsourcing tax concerns are clarified favorably, TCS would see its business pick up again. In any of these cases, I would be an investor in mainstream IT stocks in India. However, in these uncertain times, I would rather go for some of the following Indian IT stocks that are less dependent on global pressures. Starting with Netweb Technologies, my premier play from high performance computing. Netweb Tech has created India's fastest supercomputer and India's second fastest supercomputer. Its exposure to space and defense has also been on the rise in recent years, highlighting that the company is moving into more technically challenging sectors. This by default creates a moat around the stock, since defense and aerospace are difficult to break into not just because of technical specifications but also regulatory approvals. The second is MapMyIndia, and this company's moat also stands on regulatory grounds. It is India's premier map maker, and since the Indian government won't be using Google Maps for its sensitive data, it is virtually certain that MapMyIndia will continue to find business, especially from defense, information technology, and organizations like Niti Aayog. Along with this, many large private firms like Airtel, Hyundai, and Flipkart are also its customers, so the company's future is secure. Finally, we have Axelia Solutions, and this is my high dividend, high beta stock. The stock is very cyclical though, so I would only buy when it is severely corrected as it is now. It also offers a brilliant 5 to 6% annual dividend, so even in the toughest of times, this stock should at least give us a beat on inflation. The sector it works most with is airlines, providing back-end solutions for them, which we know is a sector that is going nowhere. Now, whether you buy into these IT stocks or any other IT stocks you like, please make sure you consider them as long-term investments, because the immediate future of Indian IT is still cloudy.